Good morning. This is Vector News 24. It is Monday, March 23, 2026, and we are witnessing a sea of red across the Asia-Pacific region. The trading day in Asia has just come to a close, and the damage is extensive. The Nikkei 225 plummeted 3.4%, finally breaking below the critical 53,000 support level we've been tracking for weeks. Across the water, the South Korean Kospi suffered a staggering 6.5% loss, its worst single-day performance since the early 2020s. The catalyst for this panic is the Hormuz Ultimatum. Over the weekend, President Donald Trump issued a 48-hour deadline to Tehran: open the Strait of Hormuz to global shipping or face targeted strikes on Iranian power plants and energy infrastructure. Iran's Revolutionary Guard has already retaliated with a counter-threat, promising to hit Israeli and U.S. IT and desalination plants if their facilities are touched. For energy-dependent Asian economies like Japan and South Korea, this isn't just a market fluctuation, it's an existential threat. With 20% of global oil and a third of LNG passing through this choke point, the risk-off sentiment is absolute. We saw massive capital flight from Asian equities into the safety of the US dollar today, leaving regional indices in a tailspin as the closing bell rang in Tokyo and Seoul. Let's look at the toxic Trinity hitting the tape right now. Surging energy, a strengthening dollar, and rising bond yields. Brent Crude has been on a wild ride. Earlier today, it peaked at $119 per barrel before easing slightly to around $116. WTI, the U.S. benchmark, has officially breached the psychological $100 mark. IEA Chief Fatih Birol warned this morning that no country is immune to this crisis, comparing the current situation to the twin oil shocks of the 1970s. In the FX markets, the USD JPY is the story of the hour. We are currently trading at 159.20, inching closer to that danger zone of 160.00. Markets are on high alert for the Bank of Japan to intervene. However, with U.S. 10-year yields surging toward 4.5%, the interest rate differential is a massive headwind that the BOJ may not be able to fight with intervention alone. The macro narrative has shifted dramatically. Just 8 weeks ago, the market was pricing in 3 Fed rate cuts for 2026. Today, that number is 0. High energy costs are refueling inflation, effectively killing any hope for a Fed pivot in the first half of the year. We are seeing a structural shift where higher for longer is no longer a theory, but a brutal reality for global borrowers. As we transition to the New York Open, the mood is somber. Wall Street is bracing for a 4th consecutive weekly decline. S&P 500 futures are currently down 1.5%, and the Dow is projected to open more than 400 points lower. Beyond the geopolitics, investors are looking for any sign of economic resilience. Tomorrow we get the flash PMI data, which will give us the first real look at how U.S. businesses are coping with these mounting supply chain disruptions. But for today, the focus is pure de-risking. We're seeing a massive drawdown in gold, down nearly 4% to $4,319, as investors liquidate winning positions to cover margin calls in equities. The king dollar is the only thing standing firm. So, what is the strategy for this Black Monday? First, watch the clock. President Trump's 48-hour ultimatum expires tomorrow. Any headline out of the Persian Gulf will trigger instant volatility. Second, defensive positioning is key. Until the Hormuz situation clarifies, energy-intensive sectors like airlines and manufacturing are high risk. Look to domestic energy producers and defense contractors as potential hedges. Finally, watch the 160 level for the yen. If we break 160, expect a violent move in JPY crosses that could ripple through all dollar-paired assets. This is a week for resilience, not for catching falling knives. We are in the middle of a structural repricing of global risk. Stay tuned to Vector News 24 for live updates as the New York session progresses. Trade safe, and we'll see you at the midday update.